Thanks for tuning into Talking Point. I'm your host, Niraj Shah, and our guest today is Vetri Subramaniam. He needs no introduction. Vetri, great having you. Thanks for taking the time out.
Delighted to be here again on this channel. It's been a long time, but wishing you and everybody else great success with this brand name. It's good to see the brand name up and running again.
Thank you. And well, it's been a long time for me to talk to you as well. The last time that we spoke to you gave this very nice acronym or very nice line. I'm looking forward to some headline-worthy stuff from you today, none less anticipated. But you know, be that as it may, Vetri, how do you feel about risk assets at the start of this calendar relative to what you would have felt maybe in 2023 or 22?
Well, what you feel is a function of, the position and the valuations and what's actually happened over the course of the year. Going into 2023, I think most of the debate was around when will the US experience a recession, not if. And I think the biggest surprise of the year has actually been the fact that the US not only did not witness a recession, it's actually navigated these high interest rates fairly well. And the markets were doing, pretty well through the course of the year. It may have been a narrow rally, but, when you see something like the NASDAQ, which is, a behemoth in terms of its market capitalization up 50% plus, and then, of course, the S&P 500 as well up almost 20%, clearly it's been a very good year for risk assets. To that extent, the valuation does leave you with a little bit of concern as you start 2024, not because of anything I can see in 2024, but simply because of the fact that this move in the markets, which is not driven by earnings, but driven by a P multiple expansion, automatically makes you slightly more vulnerable. So I think that's the backdrop. And just two other quick points to make. I think the robustness of the US economy was one surprise. The second surprise to some extent has been the fact that Europe has navigated this whole energy crisis over the last almost 2 winters extremely well. Maybe global warming helped. We know 2023 was, the warmest year on record. But be that as it may, Europe has managed this energy shock quite well. Here again, the US played a role. I think US production of crude oil has surprised to the upside and compensated for any supply cuts that the OPEC might have brought about. So I think these two factors perhaps sort of were the unexpected events of 2023, which helped markets higher. But, I think things look more challenging now because of the valuations.
So actually, that's the key point. Yes, valuations are high. Some would argue that valuations in Indian context are always very high, but be that as it may, valuations are high, Vetri. The point is, how do risk assets align themselves to a higher than the previous normal on interest rates, but in a calendar year where interest rates come off and just give it a little bit of boost to that risk sentiment if they do?
Okay, great. I think there are 2-3 points we need to think through here, Niraj. One is, I think, the era of 2000, let's say post-GFC and post-pandemic, also all the way up to 2021, is now behind us. This was an era where rates were close to zero in the developed world. This was an era where we had at peak almost $18 trillion worth of bonds trading negative. I think that era is now firmly behind us. We are entering an era of, I think, more normal monetary policy. That's also because we are most probably entering an era where inflation turns out to be more persistent, simply because economies are having to invest more for the clean energy transition. Supply chains are getting fragmented, but there's also this thing of strengthening national supply chains. And as a result of that, you are introducing frictional costs into the global economic system. Finally, the developed world has discovered that fiscal deficits can actually be a good thing. Now, these are not good things for the very long term, but they have allowed their fiscal deficits to expand and stay elevated. I think all of this creates a backdrop of higher inflation and higher interest rates. So I don't see rates going back to the previous decade. It maybe goes back to the decade, prior to 2008. And that puts us in very different trajectory. From an equity market point of view, to be very precise, what really matters is the differential between the growth rates and cost of capital. It's not just about cost of capital. And when you look at that differential, I think things look, slightly more difficult, not just for 2024, but also in terms of the way we need to think about this structurally.
Okay, so how would you think about it, Vetri? Please take your time, but just tell us what would your mental model be when you try and value equities over the next 2-3 years, assuming that the hypothesis that you're laying out works out to the T.
Sure. I'm not going to talk about the global stuff in that context.
Sure.
I'd rather pivot back to just talking about India.
Yeah.
I think when we look at the Indian scenario and we look at everything that's going on in the economy, I think a 6.5% GDP growth rate is the number which looks quite sustainable. I think one of the unique things that we've seen develop over the last few years, certainly this has been an outcome of the flexible inflation targeting, is that there's a lot more agreement between government and the MPC and alignment of policy to make sure that inflation stays controlled. So you may be talking about an economy in which nominal GDP growth is about 11 to 12%. We've seen profits as a percentage of GDP move up quite sharply over the last 3 years. If you look at 2020 to 2023, there's almost a 70% jump in profits of the Nifty 50, which has nothing to do with the change in GDP growth, because nominal GDP growth barely grew at 5 or 6% during that period. So you've had this huge, profitability expansion. It's still not reached the peak in terms of profits to GDP, but essentially I would submit that for profit growth to be significantly ahead of GDP growth, to my mind, is now quite challenging. Also because we need to raise the level of investments which are happening in the economy, because we have some of those same issues of having to invest for the future, the climate transition, so on and so forth. So be that as it may, when I look at starting valuations today, they do look slightly on the expensive side, but I'd like to parse that further, Niraj, because when I look at the large caps, they're expensive, but it's not nosebleed. In fact, I would argue it's in the comfort zone, but in the upper end of the comfort zone above the long-term average. I think where things to me look much more challenging is actually in the mid-cap and small-cap space. This is one of the unusual times in my career where I actually look at valuations on the small-cap index and find it to be at a premium to the large cap index. Now, I find this a little hard to digest. Look, we've got an economy which has got good growth prospects over the short to medium term, but we've also got to think about risks. And when risks emerge, as they will, and they are unknown and they are uncertain at this point of time, we know that smaller companies are more vulnerable to changes in interest rates, to changes in business cycle, to changes in regulations. They don't have the kind of management depth that larger companies have. And all of that is the reason why I would argue they typically need to have valuations at a discount. So risk appetite in India, to be very clear, is actually a lot more elevated than I would be comfortable with, particularly when we talk about small and mid caps. Large cap space is a slightly better scenario.
Somebody made, and it's a fair point, Vetri, but I'm just wondering, somebody made this point that valuation comfort is in large caps. But that's not necessarily where the India story is, because a lot of sectors that are getting formed in the last 2-3 years don't necessarily have a large cap presence. So could it be that while the doubts around the valuation of the broader index continue to stay, because you're right, it's kind of quote unquote egregious, but there are enough and more pockets within that which are showing promising very strong growth and could stay elevated at multiples because the growth numbers will make up for it.
So 2 points over there. Look, I could always be proven wrong. It won't be the first time I've been proven wrong. Market is something which teaches you new lessons all the time. But there are just 2 points I'll make, Niraj. One is I don't go by stories. I prefer to go by the facts.
Okay.
Right? The facts are we've never seen periods, even going back to 2003, 2008, which I would say was really sort of one of the remarkable periods for the economy in terms of expansion. We didn't really see a pattern where the small caps could consistently navigate, dramatic changes in regulations, changes in cycles, changes in global trade flows, as well as the large caps could. So I would say the data doesn't back that premise. the only way this premise would be proven true is if we have this conversation 2 to 3 years out, Niraj, and I'm happy to come back. And at that point of time, we actually see that the small corporate sector has ended up with better metrics than the larger corporate sector. Now, if that were to happen, obviously I would be proven wrong 3 years down the road. But that's not the way I've seen things operate in the past, either in India or, in global comparables. So I would be wary of taking that bet.
That's a very strong point, viewers. History may not repeat, but it often rhymes, and I think you need to take lessons from history. Is one of the key points that Vetri Subramaniam is making right now, keeping in mind the valuations that the small caps are trading at. But he made some very interesting points on the large cap piece as well, and we'll talk about all of this on the other side of this very short break. Stay tuned. We are in conversation with Vetri Subramaniam on Talking Point. Back with Talking Point on NDTV Profit in conversation with Vetri Subramaniam. Vetri, just before I dwell into what within the equities construct might look appealing to you guys as a house, I'm just inclined to understand from you that while there is discomfort around the broader end of the spectrum on the valuation front, and you made this very interesting point before the break about how history teaches us that not all of these small companies manage to do things very well over a long period of time, because relative to large caps, if you will. But I want to ask you about some of the pockets which have caught the fancy of the investing world in India and do not have a large cap presence. I mean, when we look at the whole push of railways, for example, when you hear Ashwini Vaishnav talking to us, talking about how the second highest allocation was to railways, and it's very likely for the next few years that may continue to be the same as India develops this space out, right? What happens to pockets like these? Because large companies have a subset of their business within railways, but there are railway-focused companies where entire business model is on this, and there is a government push for this. This is just an example, but I want to start off with this.
Sure. Good question over there. And I would only submit to you that also look at the fact that, cycles do play out. We've gone through a cycle where I think this government has done a fabulous job in terms of where the road program has gone through Bharatmala, which, started 2017. Of course, you could say road building started with the Golden Quadrilateral many years ago. But even it's instructive to look at where we are over the last, 5 to 6 years. We've seen road building do very well through various rounds of the Bharatmala program. I would say some of the companies executed well, but also take a look at where their valuations are today. right? You can go back and look at those valuations. So the point is, stocks do run up ahead of, the growth coming through, but you can have two outcomes. This time around, we've seen the case in which some of these companies have had good outcomes in terms of managing their financials. But as you go through the growth cycle, then those company valuations tend to come off rather than remain elevated. And that's exactly what we've seen play out in, road construction companies, which I would say is actually one of the unloved segments of the market today. So you've got to be careful about, paying top dollar for that. The second thing that you need to be careful about is, again, go back and look at when some of these large opportunities to invest do come through. Look at the infrastructure boom of, the mid 2000s that I talked about. Now, at the point where the stories look very, very attractive, the stocks did run up. But a story is only as good as execution. And wherever companies then faltered in terms of their execution, there was a very high price to pay, because many of those balance sheets also ended up bloating up debt quite significantly. So I completely agree with you. There could be few companies that turn out to be winners, but that's different from saying an entire aggregate sector can be lifted in terms of valuations. And then you're ignoring the fact that eventually it is execution that converts a story into profits and converts that into shareholder value creation. Not every company is equal to the other in terms of its ability to convert a story into profits. We're talking today when one of the two large IT majors have reported results. Just go back and look at the excitement in 99, 2000 in terms of IT, and see how many of those companies actually navigated what has been one of the most fabulous growth stories in India over the last 30 years of my career, but how many of them actually pulled it off over the next 10 years and survived as being meaningful companies. So I think it's the separation of the men from the boys that we need to worry about when we talk about these themes getting overpriced. I don't mind one or two stocks trading at a premium, but when a theme gets overpriced, light bulbs go off in my head.
Wonderfully put, Vetri. Thank you for this. And viewers, there's so much to glean from about investing per se from this one answer about railways, but so many other sectors. I'm guessing, Vetri, the same argument would probably extend to a bunch of other sectors which as a basket are getting valued, right? Maybe some bit of defense, maybe some bit of some of the other spaces as well, right?
Sure. I would just recommend to investors to read up about how difficult defense execution is. Actually, you can even find records of this in our own history in India, but you can also see at how companies struggle to execute complex defense projects that involve bringing together and assembling products from different parts of the world. When you read anything about the US defense industry, there is a great opportunity there, but I think we will discover 3 to 5 years down the road that there were only few managements that could pull off execution of those complex projects.
Got it. Thanks, Vetri. This is pure gold. Okay. Now the other aspect, you spoke about the IT majors. I mean, there's a lot of flutter around what will happen and why this excitement in IT, wherein in December, Accenture has said, okay, bhai, things are not necessarily looking all that great. There is a little bit of excitement that came in post. These guys not doing as badly as maybe the street thought. Now, not doing as bad, is that good enough for people to be excited about a space which might not have great discretionary demand for the next 6 months at least?
I think that's a valid perspective. Look, I like the IT sector and some of the companies there purely because they've got fabulous business models. They throw up cash. People talk about their growth slowing down, but I would also equally argue, look at how much they have to invest to actually get that growth. The ratio of the growth they get related to the capital they invest is still quite fabulous. Right. So that's the way I look at it. But I tend to agree with you. To my mind, the growth trajectory is still looking slightly challenging. As I said, we like some of these companies bottom up because they're globally competitive. They throw out cash flow, cash generating machines. But IT, to my mind, is right now more a buy the dips approach rather than something that I really feel very, very excited about. Funnily enough, IT has actually outperformed the benchmark over the last 12 months. So maybe it's just come out of complete deep depression into sort of, more sort of normalcy. I like the companies there, but it's really one of my buy the dip sector than something that I feel hugely excited about.
And is that sector slightly different than the others, Vetri, in that the small caps out there or the non-nifty names are not necessarily small caps? They are experienced companies having ridden the cycle very well, as much as the Infis and the TCSs have done, so to say, in terms of time, more or less. So that's the first part of my question. The second part of my question is a note that I saw HSBC write, wherein they make this point about ER&D stocks, saying that their valuation multiples are elevated, but because of the nature of the execution that these guys are doing and the growth rates that they are seeing, maybe they deserve those elevated multiples. So is there an exception that you would make for elevated multiples in that whole bucket of ER&D? So two-part question here.
Yeah, let me just roll it back. I don't want to comment on that specific report or that I'm not seeing.
Sure, of course.
But let me just put it this way. I think one of the things that we are clearly seeing in IT, and this has just got to do with the way the business is evolving, is some of the mid-sized companies, so therefore in that sense their market cap is mid-cap, but they don't have a legacy business which is declining at a very high rate of growth. I think the challenge for some of the larger companies is that they've got these new growth engines, but they've also got a legacy business which is declining. So their growth outcomes are a function of these two contradictory forces. For some of the mid-sized companies where there's no legacy business, what you're seeing is a higher growth outcome for the company because they are more focused on some of those business lines which are still going through reasonably good customer momentum. Second thing I would say about some of the, the non-mega cap IT companies is that they've got a track record of demonstrating how they've navigated through cycles, which to my mind therefore makes them very different from some of maybe the other areas where there are stories, but I don't have the ability to understand management capability in terms of how they've navigated cycles before. So I think there is a reason why some of those mid-caps have traded up to a premium. It's the lack of a legacy business and fairly superior growth outcomes why that's happened. I can understand that. I think, this whole ER&D, if I just step back and say, I think there is a, line of business which is evolving within IT services, which has got to do more with sort of support to global R&D. It's an interesting area. It's an area we like. And I think over there, the growth rates can be much stronger. And, US companies are now in this domain discovering the benefits of outsourcing to India. So again, that's an area where a slight premium to traditional IT services may well be justified.
Got it. Vetri, I have time for one more. So instead of me tossing a theme at you, I'm just trying to understand within this landscape wherein you find comfort in the larger names, so on and so forth, where is it that you personally believe the next 2 years or 3 years or 12 months, if 24 months is too long a time frame in the current volatile times, where is it that you find comfort?
Sure. So great question. And I'm glad you used the word comfort because I always tell people I don't know what will happen in the next 12 to 24 months, but I know the wicket I want to play in because I play on the wicket. The valuations give me comfort. I like the big banks. So in general, I like banking and financial services. It's done nothing much through the past year, but that's only made the valuations more attractive. So that's a wicket I'm happy to play on. Healthcare. Pharmaceutical, it actually had a fairly good year last year in terms of outperforming the benchmark, the entire sector. But I think it's still sort of attractively placed in terms of how those companies are positioned. So these are two sectoral or beta themes that, we feel positive about and we've been talking about to people. I'll also add one more out there with a caveat because you mentioned about new business models. Now, in October last year, we launched an innovation-themed fund, which invests in many of these new business models. But let me be very clear. It's not like we have valuation comfort over there. We're just saying that maybe some of these companies will emerge much bigger and stronger in the future. So it's a strategy you might want to use as a little bit of a sprinkling on top of your portfolio and invest in that theme through a systematic manner. It's not a great place for lump sum. It's going to be a volatile journey. But it could be an interesting area to put some risk capital and sprinkle on your portfolio.
A bit of a VC option for a retail investor, if you will, Vetri?
Well, not VC because these are listed companies, but it plays to the productivity gains that B2C, internet-based businesses are able to deliver. It plays to the E&D space. It plays to some of the companies involved in climate transition and in terms of support of global R&D.
Great. Vetri Subramaniam, such a pleasure talking to you. Pity we do it only once a year. Would love to have you more, but thank you for taking the time out and doing this at the start of calendar year 24 nevertheless.
Great. Look forward to doing it more than once a year, Niraj.
Thank you so much, Vetri, and viewers, thanks for tuning in.
Friday's rally extends to Monday. Benchmark scale fresh highs for a second day. Sensex starts the week above 73,000 mark and Nifty soars to 22,000. Broader markets remain firm. Mid-cap and small caps open in the green. Meanwhile, Nifty IT skyrockets over 3%, followed by Realty and PSU banks. On the other side, farmers underperformers.